Hey guys, it's James Dainard and welcome back to Bigger Pockets on the Market presented by Fundrise. Today we're going to be talking about passive income and active income and what is the right thing for you.
Only problem, I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money.
So the amazing thing about real estate is vast. There's unlimited amount of potential investment opportunities, and it really comes down to how active or non-active you want to be when making that next decision. If you want to be more involved in your transactions and control your own fate, then maybe an active investing lifestyle is a great way to go. Are you someone that maybe has a full-time job and doesn't quite have the time to do all the implementation, but you still want to invest in real estate, then passive is a good way to go. So really, what's the big difference between an active and a passive real estate investor? So how I define it is an active investor is a person that's participating in the investment all the way through. They're going out, they're finding their deal. They're lining up their funding for that property. How are they going to pay for it? Then they're going to put together their rehab plan and put that plan in place and make sure that it goes on efficiently. And then they're going to stabilize it and get the income to be producing. So a passive investor is someone that wants to take more of a back seat. They love real estate as an investment engine, but they don't want to do all the legwork to get it to that stabilization period. So a passive investor is not only looking for real estate opportunities, they're also looking for operator opportunities. So if you can invest in someone else's deal, why would you even want to be an active investor, right? Like someone's going to find you that property, you're going to invest in it, you're going to get your return. Well, there's many variables of why people pick and choose on whether they want to be hands-on or off. For me personally, I'm a very active investor. I like being in control. I also like being very specific on what kind of property that I'm targeting. I might like a different type of asset than other type of operators in the area. That's not good or bad, but it's whatever works well for me at the end of the day. So there's different types of active real estate investing that you can get involved in. Probably the most popular is going to be your BRRRR or your fix and flip properties. Fix and flip or BRRRR style properties are typically high active investor participation. You gotta find the property. You gotta analyze it correctly. Is it profitable? Can you refi out most of your cash? You then have to find a contractor, manage that contractor through the implementation process, and then either get it stabilized by refinancing and renting it or then selling it. But it's a very active participation all the way through. The benefit is you get all the upside 100% as the investor, as the flipper or as the BRRRR investor. So you're owning the property 100%. And the margins can be huge. Over the last 12 months, we've seen nearly 50 to 60% returns on our investments in a 6-month period on most of our fix and flip product. So if we're investing in an operator, we'd be giving away a big chunk of that margin. Development is also a very active real estate engine. As a developer, you're going out, you're sourcing that property. You're finding that next potential raw piece of land. Then you're hiring an architect, achieving building permits, hiring a builder, building the structure, and then selling it down the road. So all these things are very hands-on. At our company, we build 25 to 30 units a year. With the cost of inflation and the shortage of employees, what we've had to do over the past 12 months is become very active. We used to hire a builder, then we contract them out, they build the site, we pay them their markup fee, but because of the lack of resources, those costs were going through the roof. As an active investor, this allowed us to change things around, and we hired everyone in-house, put the plan in play ourselves, and could control our cost. Again, that is another benefit of being the active investor. You have full control. You can make the calls and the changes on the plan, whereas if you're a passive investor, you're more taking the back seat. Another avenue for actively investing is just buying a single family rental property or a multifamily rental property. The beautiful thing about those types of asset classes is you can kind of pick and choose how hard you want to work. You know, some people are very uncomfortable investing in someone else's projects, but they also don't want to do a heavy value add or a BRRRR property where they got to find the property, work on it for 6 months, and then stabilize it. It's just too much work. So the cool thing is you can find something in the middle. You can still own the asset, you don't have to invest in someone else's business, and you can buy the right kind of product and put the right systems in place. Most of those active investors are targeting more Class A product or Class B product where it's already stabilized or it's already rented out. It doesn't need a lot of repair work. And then also they implement property management because they'd rather pay the cost of the 7 to 8% rather than give away equity in the deal with an operator. So there's unlimited ways for you to get involved in real estate. You can be active, you can get your hands dirty, you can be flipping the homes, you can do it a little bit more laid back, rent them out with property management, or if you don't want to deal with any of it, you can just be passive. Passive real estate investing is great for many working professionals or people that maybe are getting into the retirement of their life and they just don't want to deal with the tenants. They don't want to deal with the contractors. They don't want to deal with the complaints. So one popular platform is investing in a syndication. What a syndication is when there's an operator that goes out and secures an investment. They find the property, they line up the financing for it, they put the implementation plan together, and then they raise the capital to fund that transaction. Typically, the operator is going to take a portion of the ownership in the property and then give the remaining portion to the investors that put up the capital. The investors are going to receive a preferred return and an equity split at that point. The additional benefit to syndicating is you don't have to put all your money in one deal. You can work with numerous different syndicators in numerous different markets and hedge your investments out. Not only do you not have to implement the plan and do the hard work, you can also be in maybe 10 different deals with lower capital all the way through rather just one. Another popular investment engine is a joint venture agreement. I actually just invested in my first passive flip with Kara Beckman down in Scottsdale, Arizona. So in this role, she found the property, she's handling the contractor, managing the implementation process, and selling the property for me. The only thing that I had to do was come up with the capital. In this specific joint venture agreement, I'm the investor and then she's the operator. How we had it structured is I put up all the capital, she does all the work, and we are splitting that profit 50-50. So the nice thing about a joint venture is there's not too many cooks in the kitchen. You don't have numerous investors all concerned with the same deal. You're working with one operator, one relationship, and you guys can help push that process through. Also, in the event that there's an issue, you can have a good conversation and navigate the process a little quicker, because again, there's less cooks in the kitchen. So another way that you can passively invest is just purchasing hard money notes. There's tons of hard money lenders out there generating and originating loans right now. Most of the time, their rates are going to be 8 to 12% of what they're lending their paper at. Many times they'll sell you interest in that note, so where as an investor, you just have to come in, contribute the capital, and they're going to pay you that same yield. The nice thing about that is you don't need to generate your loan. You don't need to originate it. You don't need to underwrite it. You do need to vet their underwriting and make sure that it's safe and protected, but all you need to do is deliver the money and you know what yield you're going to get. In addition to, another benefit is most of these notes are short term, 1 to 2 years. So you're deploying money, you know exactly what you're going to make and when you're going to get it back at that time. So now that we've talked about a few different avenues for passive investing, now we need to talk about how do you protect your money before you give it to that next operator. Remember, it is your responsibility as the investor to vet your operators. Not only when you're passively investing do you need to look at the analytics of the deal and make sure they check out, you need to make sure that the operator checks out as well. So before I invest in anybody else's deal, there's certain steps that I take to vet that operator. The first thing I do is check their experience. How many deals have they completed? Not just started the process on, have they got through the stabilization, and then I want to see how their end metrics actually ended. I want to see the proof. The next thing I want to know is what's their qualifications? What kind of backgrounds do they have? Are they a construction guy? Do they run tons of different types of remodel projects? Do they come from a banking background? I want to know where their skill sets are just in case in times of emergency that we know we can tap into them. A lot of people that invest in our types of real estate businesses, whether it's our lending business or syndication, invest in us because of our experience background. Not only do we understand the banking background because we're lenders, we're also experienced operators and construction guys. If something goes wrong, we know how to dive in, fix the problems ourselves, not just hire it out and create the right solution. So when I'm talking to my operators, I want to make sure that they have a hands-on depth of what they're actually trying to facilitate. The next thing I check into is what's their culture and infrastructure. Who do they have behind them to help make sure that this is going to be successful? Who's their legal team? What kind of paperwork do they have in place? Who's their accounting department? What kind of reporting are they going to deliver us? How do they track their expenses? You need to make sure that they know how to control their cost and understand their cost. And then general of who's implementing the plan on their team, who's running their construction points, who's going to be handling their marketing and the lease up. I want to understand the process all the way through. And not only that, I want to make sure that they have the bodies to make sure that they can facilitate that process. The next is liquidity. I want to make sure that my operator has some sort of funds. If my operator spends all of their earnings in than all of their income, I'm going to be a little bit concerned about investing in their kind of product. Do they have good credit? Do they have a history of paying their bills? If they don't have a good history of paying their bills, I probably don't want to invest in them because that's showing me that I might not get my money back. If they do have something on their credit report, have good communication with them, find out what the reason was, maybe it's explainable, and then move on. The next thing I look for, do they have any kind of legal trouble or investigations that are open? The last thing you want to do is invest in an operator that could be being audited by DFI or the SEC, and that you are going to get dragged into a mess that you didn't know about. So make sure they're running their business in good standing and they don't have any open violations. And lastly, I want to make sure, is the paperwork correct? Did they set up their fund docs correctly? Is the LLC agreement legally written? Is my joint venture a legally binding agreement? These are all red flags for me when I'm looking at an operator if their paperwork is not tight. The last thing I want to do is invest a bunch of money into a person that doesn't have their infrastructure right. So make sure your paperwork is correct. Take it to a legal counsel, have them look at it, and before you sign that agreement, make sure everything looks good. So now the real question is, what kind of investor are you? If you're a new investor and you want to get your hand dirty, I would suggest becoming an active investor. Own your own assets. Get involved. You can kind of create your own destiny. As a young 23-year-old, when I got started, that's how I've grown my portfolio. I would target the biggest value-add properties that I could find, buy them, stabilize them, create the biggest margin, and then roll it into another property. If I was being a passive investor, it would be a lot harder for me to do because I don't have any say in what properties I'm buying, and I'm sticking to someone else's plan. So by being active, I can be more hands-on. The downside is it requires a lot more time. You have to spend countless amount of hours trying to find that deal, managing those people. You have to deal with those late night phone calls from tenants or different types of property managers, and there's work involved. Hence why you can make more money. The more work, the harder the work it is, the more return that you have on a possibility. So now that we've gone over some active and passive different real estate platforms, you want to ask yourself some key questions to determine on what you want to do. A, do you have the time to go find that property, implement the plan, and manage the people involved to put it all together? Do you have the experience to do so? Sometimes you may have liquidity, you want to buy real estate and get into big projects, but you might not know how to build townhomes or remodel a giant apartment building. So you can still get involved by being a passive investor. What is your return on time? Depending on what you have going on in your career, if you have a thriving career where it's blowing up and you're making tons of income, you might not have the time to manage each type of project. That is a great reason to become a passive investor and invest in someone else's processes and still not deter from what you currently have going on. Thanks for joining us on Bigger Pockets on the Market YouTube channel presented by Fundrise. If you enjoyed this video, click like and subscribe, or for more free real estate fix and flip tips or wealth tips, check me out on Instagram, JDaneFlips, or our YouTube channel, Project RE.